Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Virgin Galactic.
If you find our talks useful, please consider subscribe, like, and comment underneath. I mean, just imagine holding a single ticket that costs $750,000.
Which is a crazy number, right?
Oh, it's absurd. Just for a 90-minute ride. And now imagine the company selling those tickets, a company that, literally physically sends human beings into the blackness of space, is currently valued at less than, like, a regional chain of car washes.
Yeah, it's hard to wrap your head around that.
We are looking at a sub-$200 million market cap today. For an aerospace pioneer, a valuation that microscopic is the stock market basically screaming, "We do not believe you can survive."
Right, the stock is essentially priced for bankruptcy right now.
Exactly. So the core mission for your portfolio today is navigating this extreme binary setup. Is this just a classic value trap that's going to, completely incinerate your capital? Or are we looking at an asset on the absolute precipice of this massive multi-year commercialization phase?
And, answering that requires looking past the surface level panic, because if you just glance at the immediate heavily discounted financials, they look disastrous.
Yeah, disastrous is almost putting it lightly.
Right. If you pull up their fourth quarter 2025 earnings report without any context, it paints a really, really grim picture.
The top line revenue for that entire 3-month period was, what, $312,000?
Yeah, exactly, 312 grand.
I mean, a moderately busy local bakery generates more revenue than that.
Mm-hmm.
For a publicly traded entity employing some of the, highest paid aerospace engineers on the planet, 300 grand it's a rounding error.
It really is.
And they even missed their target, which was already set at this incredibly low $495,000. Any traditional stock screener looking for, revenue growth is going to flag this as a dying business immediately.
They absolutely would. But that revenue number is actually, it's a distraction.
How so?
That microscopic top line isn't a symptom of customers, walking away or canceling tickets. It's actually the result of a very deliberate, highly orchestrated pre-commercial transition phase.
So they chose to do this.
Exactly. They made the strategic choice to pause all commercial flights. They entirely retired their older generation spacecraft, the VSS Unity, just to clear the board.
Gotcha.
The goal was to dedicate 100% of their resources, their engineering hours, facility floor space, everything, to building their next generation fleet, which is the Delta-class spaceships.
Which really requires a completely different way of evaluating the business. I think think of it less like a struggling airline and more like a massive theme park operator.
Okay, I like that.
Imagine you own a wildly popular but very small boutique amusement park. The demand is huge, but you only have the capacity to let, say, 50 people in a day.
Right, so you're bottlenecked.
Exactly. So to scale up and make real money, you decide to build this massive interconnected resort world right on top of your existing footprint. You can't safely keep running the old roller coaster while bulldozers are ripping up the foundations right next door,
No, of course not. You'd have cranes swinging steel overhead.
Right, so you have to shut the park down completely. And when those gates lock, your daily ticket revenue instantly flatlines to zero.
Which looks terrible on paper.
It looks horrific. But as an investor looking at that theme park, you shouldn't be panicking over the zero revenue because you know why it's zero.
Yeah.
You should be scrutinizing how management is rationing their cash reserves while the gates are closed.
And that cash management is the only metric that really dictates survival right now. And this is actually where we see a significant bullish divergence from the panic narrative.
Okay, lay that out for us.
Well, management has ruthlessly and successfully right-sized their cost base. In that same fourth quarter of 2025, the earnings per share came in at a loss of 98 cents.
Which, nobody likes a loss, but...
Right. But Wall Street analysts had priced in a much steeper loss of $1.05 per share. So they beat expectations on the bottom line because they aggressively slashed operating expenses and research and development costs.
They trimmed the financial fat at the exact moment they needed to hibernate.
Exactly.
But that hibernation relies entirely on their financial runway. I mean, taking the theme park analogy to its logical conclusion, you need enough cash in the bank to actually finish building the new rides before the lenders force you into bankruptcy.
You do. And Virgin Galactic ended the period with $338 million in cash reserves.
Okay, 338. But the burn rate is intense, right?
Very intense. Their guidance for the first quarter of 2026 anticipates negative free cash flow of $90 to $95 million.
Wow. Burning nearly $100 million every 90 days against a $300 million reserve. That means the clock is ticking incredibly loudly.
It puts them on a strict mathematical timeline of about 3.5 quarters before the runway just completely vanishes.
That's terrifying.
It is, but management has stated publicly that this specific cash burn is fully funded to carry them to their commercial launch target in 2026. This isn't money being lost to operational inefficiencies.
It's not just paying the electric bill.
Right. It's the final heavy lifting capital expenditure required to actually finish the Delta fleet.
Yeah.
Assuming there are no major engineering delays, they have the capital to cross the finish line.
And crossing that line fundamentally alters the unit economics of the business.
Completely.
Because the price of admission is changing drastically. When operations finally resume with these new Delta-class ships, the ticket prices are hard-coded at $750,000 per seat.
Which is a massive expansion in revenue per user.
Massive. You only need to fly a fraction of the passengers to generate exponential top-line growth.
Yeah.
It completely redefines the profitability model.
It does.
But, and this is a big but, surviving the cash burn and finishing the ships only matters if there is actually a lucrative, defensible market waiting for them when the hangar doors finally open. We really have to look at the moat.
Yeah, the competitive moat here is built on a few very distinct pillars. First is that first-mover brand advantage in a sector with an absurdly high barrier to entry.
It's not a cheap industry to get into.
Not at all.
Yeah.
Building a commercial space company isn't like coding a software startup in your garage. It requires decades of regulatory approvals from the Federal Aviation Administration, highly specialized physical infrastructure, and, a proven safety record.
Right.
Virgin Galactic is one of the very few pure-play options available to the public. And second, they utilize a highly unique air launch system.
Let's actually break down the mechanics of that air launch system, because
Yeah.
I think it's not just a gimmick. It's a structural advantage.
Yep.
Instead of blasting off vertically from a concrete pad on the ground, which requires fighting through the thickest, most turbulent layers of the Earth's atmosphere right from a standstill, they use a massive mothership.
Right, the carrier aircraft.
Yeah. This carrier aircraft flies the spaceship up to about 40,000 feet and drops it. Only then does the rocket ignite.
Which changes the whole equation.
It really does.
Hmm.
By bypassing the lower atmosphere, they avoid almost all of the weather delays that plague traditional rocket launches. Plus, they require significantly less rocket fuel to reach suborbital space.
And from a consumer standpoint, it offers a completely different, remarkably smoother flight profile for the passengers.
Right, which is huge when you're flying civilians and not trained astronauts.
Exactly, and those passengers are already lined up. We know the demand for this specific flight profile exists because they are sitting on a massive backlog of customer deposits, and these are explicitly locked in at that new $750,000 price point.
Wow. So that backlog really validates their pricing power. The market has proven it is willing to pay the premium.
And it absolutely has.
But let me challenge that market thesis for a moment.
Mm-hmm.
We're talking about their specific moat, but we cannot ignore the absolute titan dominating the space sector right now.
You're talking about SpaceX.
I am. Rumors are swirling heavily right now that SpaceX has confidentially filed for an initial public offering at a staggering $1.75 trillion valuation.
Oh.
Trillion with a T.
It's an unfathomable number.
It really is. So if a behemoth of that magnitude enters the public market, doesn't it just suck all the institutional oxygen out of the room?
Uh-huh.
Why would a portfolio manager allocate capital to a tiny, sub-$200 million company fighting for survival when they could simply buy the undisputed heavyweight champion of the industry?
That's a very common assumption, but institutional market mechanics usually trigger the exact opposite effect in emerging industries. Yeah, it creates a rising tide phenomenon. A $1.75 trillion IPO doesn't drain capital. It actually forces Wall Street to officially legitimize the entire space economy.
Okay, how did that work in practice?
To understand this, you have to look at how massive pension funds and portfolio managers operate regarding sector rotation.
You mean the benchmark tracking requirements?
Yes, exactly. When an industry gets large enough, it becomes a heavily weighted, recognized sector in the major indices. Suddenly, funds are mandate-driven to hold a specific percentage of their billions of dollars in space exposure.
They don't have a choice.
Right, they have to buy in. But not every fund manager wants to buy into an IPO at an astronomical, potentially overbought valuation like $1.75 trillion.
That makes sense.
Furthermore, there might not even be enough available shares of the giant to satisfy all that institutional demand. So what do the fund managers do? They actively hunt for undervalued, publicly traded proxies.
The cheaper alternatives.
Exactly. They look for the beaten-down, pure-play companies that naturally benefit from the industry's validation.
It's like they're forced to buy the neighborhood because the new mansion drove up all the property values.
That's a perfect way to put it.
Combine those SpaceX IPO rumors with the ongoing talks of, say, Amazon potentially acquiring Global Star, and you have the fundamental ingredients for aggressive sector rotation. Investors are starved for space exposure.
And these massive macro events create a halo effect. They disproportionately benefit a company like Virgin Galactic simply because it is a publicly traded, pure-play asset sitting at a rock-bottom valuation.
And this macro-level excitement isn't just theoretical, is it? It's already aggressively warping the stocks chart and trader psychology.
Oh, absolutely. The market is actively repricing this asset from a distressed classification, something heading for bankruptcy, to a growth classification nearing commercialization.
You can see it in the recent price action.
Just look at the violent reversal in bearish sentiment. Following the earnings announcement, the stock surged 16.1%. Then, on March 31st, 2026, it saw another massive single-day surge of 19%.
Which is wild. For a retail investor, seeing a stock jump 19% in a single day can feel terrifying. It feels like chasing a falling knife.
It definitely does.
But that kind of volume isn't driven by, retail traders buying a few shares on an app. That is institutional money violently repositioning.
And institutional analysts are actively validating this turnaround story. On April 2nd, 2026, Jefferies issued an updated analysis.
What was their take?
Well, they lowered their price target from $8 to $5, but the critical takeaway is that they maintained a buy rating on the stock.
Maintaining a buy recommendation when a stock is essentially trading on the floor is a massive vote of confidence.
It really is.
If the underlying fundamentals were truly broken, if bankruptcy was the most likely outcome, a major firm like Jefferies would have immediately downgraded it to a hold or a sell to protect their clients.
Exactly. Keeping that buy rating signals to the broader market that the asymmetric upside is highly credible.
And that asymmetric upside is magnified by the current trading mechanics under the hood, specifically the short interest.
Yes, this is a huge factor.
There are currently 16.94 million shares sold short on this stock. That creates a highly volatile powder keg.
It's a massive amount of short interest.
To really understand why that specific number makes this setup so explosive, let's break down the actual mechanics of a short squeeze for you guys.
Yeah, let's unpack that.
When traders short a stock, they are borrowing shares they do not own from a broker, selling them into the open market, and betting that the price will crash. The goal is to buy those shares back later at a much lower price, return them to the broker, and pocket the difference.
It is a direct bet on the company's failure.
Exactly. But here's the catch.
They are legally obligated to buy those shares back eventually.
Yes. That legal obligation is the trap. Imagine a commercial flight that is massively overbooked. The airline has sold 16.94 million tickets to people who absolutely legally must be on this flight to avoid financial ruin.
Okay, I see where you're going with this.
Now imagine the plane is boarding and there are barely any seats left. Suddenly, a piece of positive news hits the wire. The stock price spikes. The brokers who lent out the shares start issuing margin calls.
Which is when the panic sets in.
Right. The brokers knock on the short sellers' doors and say, the price is going up, you are losing our money, buy the shares back right now and return them.
And the short sellers lose all leverage.
They're basically trapped in the terminal, frantic. They have to buy a seat on that plane regardless of the cost. The few people who actually own the shares can suddenly demand whatever price they want.
Because the buyers literally have no choice.
Exactly. As the desperate short sellers buy up shares at higher and higher prices, it drives the stock price even further up. That higher price triggers more margin calls for other short sellers, forcing them to buy in a total panic.
It creates a massive upward feedback loop.
Yes, if Virgin Galactic drops a genuinely positive, unexpected catalyst, those 16.94 million shorted shares become guaranteed, forced buying pressure. That can send the stock absolutely soaring in a matter of days.
But a short squeeze needs that initial spark to ignite the panic. And that brings us to the most critical phase of our analysis, the imminent make-or-break execution timeline.
The catalyst calendar.
Right. The catalyst calendar over the next few quarters is incredibly dense, and it serves as a sequential stress test for the entire company.
Let's map out that sequence, because with a cash burn of $95 million a quarter, the margin for error isn't just thin, it's entirely non-existent.
The sequence begins right now in April 2026 with the ground testing of the next-generation spaceships. This is the ultimate binary event.
So what does ground testing actually entail?
Ground tests are where they rigorously validate the structural integrity, the avionics, and the pressurization systems, all without risking human life. It either passes the engineering thresholds or it doesn't.
Okay, so assuming the airframes pass the April stress tests, what is the next domino to fall?
Moving into the second quarter of 2026, the market will look for secondary operational signals. This includes major updates on the development of their Italian spaceport.
Why Italy? Why is that important?
It's crucial because it proves to investors that management is already executing on global scaling and international commercialization, not just, flying out of a single domestic desert in New Mexico.
Yeah.
Q2 will also bring major structural assembly milestones for the rest of the fleet,
But the real validation only happens when the rubber actually leaves the runway.
which is scheduled for the third quarter of 2026. That is the target for comprehensive flight testing.
That's the big one.
It is. If the ships perform as designed in the air, the timeline culminates in the ultimate revenue inflection point. The fourth quarter of 2026, when full commercial launches at $750,000 a seat, officially resume.
Looking at that timeline, we have to talk about the execution risk. We're talking about human spaceflight here. It is arguably the most unforgiving engineering challenge humanity has ever attempted.
Absolutely.
The laws of physics do not care about your quarterly earnings schedule. So what happens to this bullish thesis if those April ground tests uncover a structural anomaly? What if they don't fail outright, but say a minor software integration bug pushes the schedule back by just 3 or 4 months?
Addressing the bear case is mandatory here. The entire bullish thesis, which we generally score as a highly favorable 7 out of 10 based on the macro setup, hinges entirely on flawless execution of this incredibly tight timeline.
Right.
A 3-month delay in software integration isn't just an administrative headache. At their current burn rate, a 3-month delay is a $95 million hole blasted right into their balance sheet.
The runway suddenly becomes too short for the plane to take off.
Precisely the danger. Any delay to the April ground tests or the Q3 flight tests would likely spark an immediate and violent sell-off.
Because the trust is broken.
Exactly. Institutional investors would instantly lose faith in management's ability to cross the finish line before the cash runs out. And the moment that faith evaporates, the fear of massive share dilution returns.
The market will just assume the company has to execute an emergency, highly dilutive capital raise just to keep the lights on.
Right, which would wipe out the value of existing shareholders. The bankruptcy risk, which is currently fading, gets priced right back into the stock immediately.
Okay, so let's distill all of these mechanics into a final verdict for your portfolio strategy. We are looking at an aerospace company with a microscopic market cap and a terrifying cash burn. But they also possess a fully funded, mathematically viable pathway to a highly lucrative commercial launch by the end of this year. We have the potential for a massive sector-wide rotation driven by an inaccessible trillion-dollar competitor and an explosive powder keg of short interest just waiting for a catalyst.
Synthesizing all of those factors, the final investment thesis is that Virgin Galactic is an event-driven hold for a 6 to 12-month horizon.
Event-driven hold.
Yes. It is vital to understand the extreme volatility risk inherent in a pre-commercial stock. However, if you are comfortable absorbing that volatility, the asymmetric upside is historic.
Historic upside.
Exactly. If they successfully validate the fleet during the April ground tests and the Q3 flight tests, the market will aggressively reprice this asset from a distressed survival play to a definitive monopoly on a new commercial frontier.
It really forces you to look at the broader history of human innovation. I mean, look back at the birth of commercial aviation in the 1920s, or the early railroad boom that connected the continents in the 1800s.
It's very similar.
It is. Whenever an entirely new, capital-intensive frontier is opened, the early innovators face a brutal reality. They endure terrifying cash burn, endless engineering nightmares, and they flirt with near bankruptcy for years.
It's a rite of passage.
Right. It is a brutal gauntlet that wipes out most of the competition. But for the few companies that actually survive that gauntlet, they effectively secure a near monopoly on an entirely new economic paradigm.
Which is exactly what's at stake here.
The ultimate question you have to ask yourself when allocating capital here is this. Are you looking at a fundamentally broken company? Or is Virgin Galactic simply navigating the brutal, yet completely necessary growing pains required to commercialize the stars?
It is the ultimate test of conviction for anyone investing in the space economy.
Thank you for joining us today. If you found this breakdown valuable, don't forget to subscribe, like, and leave a comment below with your thoughts. We'll see you next time.